Measurement fundamentals continued. Accrual accounting recognizes revenues when they're earned, number one, and number two, when they're realized or realizable. So what does that mean? Well, revenues are earned when the primary revenue generating activities are substantially completed. That means the title to the goods or the services has passed from the seller to the customer. In other words, the customer assumes the ownership. And number two, revenues are realized or realizable when the cash is either collected or there is a viable, measurable claim to the cash. And a viable claim is one that is expected to be collected under normal terms of collection. Notice that the actual receipt of cash is not required for revenue to be recognized. In many cases, cash it happens either before or after the revenue recognition. So we will see that in accrual accounting, many times we have to make adjusting journal entries to recognize the revenue in the period that it's earned and not necessarily when the cash occurs, or when cash is received, or at all. Now, there are 4 criteria for recognizing revenue. And the first 3 have to do really with when is revenue earned, and the last one has to do with when it is realized or realizable. So the 4 criteria are, number 1, the company has completed the significant portion of the production or sales method, meaning they're either done or they're almost 100% done with whatever they were doing to produce those goods or services. Second, the amount of revenue can be objectively measured. In other words, the sales price or the purchase price from the buyer's point of view has been determined, and they know exactly what the amount is, and it can be measured. Number 3, the company has incurred the majority of the costs, and that the remaining costs are reasonably estimated, meaning that the company has, say, delivered the good or service, and if there's a warranty involved, that those remaining costs that would be incurred under warranty can be reasonably estimated. And the 4th criteria, which was what is realized or realizable, is that the cash collection is reasonably assured. In other words, you haven't sold to a customer that is a poor credit risk or probably won't pay. So we're reasonably assured that who we're selling to, that cash will be collected from them. So that is a bit about revenue recognition, either looking at it from the 2 criteria of earned and realized, or the 4 criteria, which goes into a little bit more depth about what needs to happen for revenue to be recognized.